Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Boy, there's so much going on this week, I'm not sure I'll be able to touch 10% of it. When they say it's different this time, it's really different this time. And normally when you hear somebody say it's different this time, they're trying to defend why share prices are going up. And that's why it's really different this time, because share prices are kind of locked, a little sideways. But that's not unusual, incidentally. Not unusual at all. And what is unusual is that there are a lot of sectors or a lot of categories for stocks at mid-cap that have not kept up with the S&P 500 over the past 5 years, and it makes the 10-year number look really bad when you're comparing them. But I'm telling you, the growth inside the companies in that index relative to the growth inside the top 50 stocks out of the S&P 500, which make up over 50% of it, there's a lot more growth. The medium-sized companies are growing a lot faster. And medium-sized companies, people think they're kind of small. Nope. These are multi-billion-dollar organizations, and they're in there, they're working, they're producing new products, they're changing the way that we live. We've got to clean up the ocean. We've got to protect ourselves from the rising waters. That's doable, by the way. The technology's there. It's getting the government to focus on that and spend in those areas. That's a little difficult. Now, eventually they will. I just hope we don't have to put everything on stilts, on the East and West Coasts before that happens, because that's kind of where they're going. And I think it's kind of funny. I was reading about this hydrogen, and Elon Musk is really upset. Well, he's not super upset, but he gets upset when people start talking about hydrogen-powered cars. And he says they're stupid. And well, that's because you make an electric car, and it's not based on hydrogen fuel cells. But I understand part of that argument, a large part of the argument. First of all, there's no infrastructure in place whatsoever. Okay, you already have an electric grid, so you don't have to spend that kind of money. And that's what he's talking about. The second thing is, well, actually, there are more than just two things. But one of the other features of what is getting the hydrogen consumes energy as well. And so he's saying, look, you're going to spend all this money to create energy, that's going to be costly. Oh, really? Generating electricity for the batteries that your cars use is not expensive. The coal and all the damage it does to the atmosphere is not expensive. Yeah, and I get it. It basically, but here's what he's saying. I know what he's thinking. He tells you what he's thinking, so it's not that hard to know. But anyway, hydrogen was seen. The fuel cells were kind of seen as maybe like a crossover phase to, at some point in time, you're going to have nuclear fission or fusion. I keep getting the two confused to say the least. Well, anyway, when that happens, and they feel like they're always about 40 years away, 10 10 years ago, they were saying, well, we're about 40 years away from it. And 10 years before that, right, they were saying, it's about 40 years off. And 10 years before that, now I'm really aging myself. This has always been 40 years away. When you can do fusion, eventually that's going to be a source of energy for everything and potentially free, environmentally. There's no environmental costs if you can get this done. That's a big edge. That's a huge edge. But we'll see. We'll see what happens. In the meantime, I know they're marching on. Everybody's advancing. Look at the number of new vehicles manufactured that are all electric. It's mind-boggling. They are making a lot of advancements in that. The advancements in solar, the advancement in wind. And a lot of old schoolers don't like to hear about that. They're really going to love fusion and fission. You should see how expensive those plants are. They don't even work yet. But at some point in time, I have no doubt in my mind that it will. In the meantime, hydrogen could be used and probably will be by some companies and countries. Some of the arguments I find kind of funny. They're like, well, you have to clean up the water to be able to treat it, to be able to use it. And I'm like, okay, and we don't need to clean the water? All that trash that they've been dumping in the oceans, that's okay with you? Sooner or later, you're going to have to clean it anyway. By the way, the element of hydrogen is the most abundant element in the universe. And I don't know, but if you've ever been to California and you've ever driven along the highway there along the coast, let's say you're headed north, all you have to do is look over your left shoulder, and that big body of water out there, that's called the Pacific Ocean. So that's where you would be taking. You would be cleaning the water to be able to use it, and that's a bad thing. Well, what are you going to do with the waste? What are you doing with the coal ash? What are you doing with that now? Okay, so if we're cleaning that up, that would be a good thing, I would think, for an awful lot of people. Create a lot of jobs, that's for sure. To be cleaning up the environment at the same time. And by the way, you know what the output or the waste product of the fuel cells are? Clean water. So you could be capturing the clean water, save it in this is like, California's got plenty of water, right? And they got those wildfires every year, got plenty of water to put that out. But all of it costs money, and that's what there's a very large hesitance for people to want to move or to change the way that they're living. But these changes, sooner or later, are going to be thrust upon people, and it's fine. I mean, it will work out. It will absolutely work out. And it's very encouraging when I'm reading about all the money that's being spent in all these areas, a lot of it by private industry, a lot of it kind of like Elon Musk and Amazon. Warren Buffett's, one of his electric utilities is the largest solar. They have more solar panels than anybody in the world. That's great. Provides jobs, provides new opportunities, and it's cleaner. It's better for the environment. And some people just love to argue, and I'm like, yeah, no, you shouldn't go into anything blindly, and they don't. I mean, there's a ton of research that goes into all this stuff, but there's a lot of stuff that you just don't know. What I'm telling you as an investor, this is a good thing. All of this, the fact that we're having discussions, the fact that we're having arguments over which way we're going to go, see, because that means they've already decided they're moving some way, and that's going to be put into place. And those people who are out there rebuilding the grid because it's incapable of delivering the electricity that we need now, okay, and never mind, as the population grows and we get more electronic devices, the growth in demand for electricity is outpacing the growth in the population worldwide. That you can Google that statistic. So how are you going to even do that? I mean, the very first thing that kids want when they get 5 years old is an iPad or a cell phone. And guess what? You've got to spend money on the electricity to recharge that thing. So, and I know that seems like a very small thing, but when you have 7 billion people, 1/2 of 1% is a big number. So it's that's what when my brain is finally trying to rest for the evening, those are the kinds of things I think about. Wow, this is going to be cool. There's going to be so much stuff. And if you'd have told me, I basically have a Dick Tracy watch on, and it's made by Apple. And you can even FaceTime on the watches if you have the cellular. But so it's literally the Dick Tracy watch. But Dick Tracy didn't think he was going to get his weather on his watch. He didn't know that. What I'm saying is that a lot of things that you think may happen, that the world will actually probably provide 4 to 5 times the number of options that you may need, and it'll get done. And it's just the nature of the beast. It's like Warren Buffett had that authorized biography. He called it Snowball. And the reason he called it a snowball is, if you remember the cartoons, the Peanuts cartoons that I used to love back in the 1960s. The snowball at the top of the hill, when you start it rolling, it's relatively small. By the time you get to the bottom, it's colossal. That's what he was talking about with his life and the company that he built, Berkshire Hathaway. And I'm telling you, he's just that's a smaller version of America, and actually a large part of the world in general. It's amazing and just fascinating. I feel like I'm living in a movie. I read and I watch and I see, and I'm telling you, if you'd told me when I was 16 years old, I think the steering wheel was about 3 feet wide in my car because it wasn't power. It wasn't you talk to a kid today about, you remember when you finally got power steering, and they're like, what? That's a term that they don't know because it hasn't been used for so long. And I just think about those cars and how mechanical they were. And actually, it was kind of nice because I was still able to work on one. But just the changes in cars today and the computers and the average car's got a couple thousand semiconductors in it. A couple of thousand semiconductors. And then on that 1972 Hornet that I had, it was all rusted out, in the late 70s. By the late 70s, it was rusted out. Kids today, if they're listening to this, they have no idea what rusted out means. Type rusted out cars on Google, and you'll get some pictures of what that is, and you're going to be shocked. You'll literally be shocked. So when I think about having lived through that and to where we are now, it is just mind-boggling. I mean, it's completely mind-boggling. And I would have never believed this. So when you're looking forward, that's what we're looking at. The snowball's gotten a lot bigger. You know what that means? It moves a lot faster. That's what it means. The snowball doesn't move that quickly when it's small. But when it's big, it moves a lot, and kind of where we're going. Having said that, I got to take a real quick commercial break. Listen, I'm going to talk about a new tool that we've had introduced to us when we come back. This is Bill Bullington right here on 1420. Stay tuned.
I got some dreams that are bigger than me. I might be outmatched, outsized, the underdog in the fight of my life. Is it so crazy to believe that you gave me the stars, put them out of my reach? Call me the waters a little too deep. Oh, I've never been so aware of my need. You keep on making me see it's way beyond me. Sometimes I wonder, is he faithful? Does he see me in my trouble? Does he understand? Sometimes I question if he's able. Can he rescue? Can he save me again and again? But when I look back, did he move that?
And I'm back. Like it or not. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you hear something you'd like more information on, feel free to go to my website. It's bullingtoncapital.com. You reach out. I'll reach out as quickly as humanly possible. And I was just talking about something that is actually going to free up a little bit of time for us at Bullington Capital. And it's a product that came out from Fidelity, actually, and they call it the Bond Beacon. And I think talk about good timing. Holy cow. You've heard me talk about bonds and bond funds and how when rising interest rates are going to cause negative returns. Well, one of the biggest bond funds in the country is run by Vanguard, and its symbol is BND. And if you go back to 2020, when it peaked and interest rates started rising, it's down about 14% right now. The share price is. Now you would have gotten the income off of that, which would have reduced your returns down to would have reduced the losses down to about minus 10% or so, depending on when you got in. Okay, so, but who wants to be down 10% of your bonds? I mean, that's a huge drag on the portfolios. And a lot of people don't understand. They'll look at that and go, well, I didn't want to take a ton of risk. Oh, okay, well, that's not a ton of risk. Being down 10% is not that bad. Relative, when stocks go down 40 or 50%. In fact, the mid-cap indexes I was just looking at, they were down 50% in the pandemic, down 50%. And the S&P was down close to 40. So from top to bottom. And those are still only down 10. But see, the big problem is they're still down 10. They have not recovered, and they're probably not recovering. So you got to be really careful how you buy your bond funds if you're going to buy them in a mutual fund. The ones that we've got are nowhere near that low. Hang on a second. Yeah, no, the one I have the biggest position, the biggest holding in is down about 5. It's half, but it's still down. I mean, that's my point. I've been talking about this for years now. Well, we finally have a couple solutions. Now, you've heard me talk about the fixed indexed annuities. That's another solution. We'll talk about that a little bit later. But this is, how do you buy bonds? The whole bond industry for retail investors really hasn't existed a whole lot because they just won't pay your financial advisors to go out there and put together bond portfolios. Well, I'm just going to put them in as part of my overall picture. And it's going to take me a long time. Like I said, the stuff that I have is okay. Its yield is about the same as I would probably get from the individual bonds, but it's not going to fluctuate as much. And you can actually time these up so that they mature when you need the money. How cool is that? Hey, next year, I'm going to have to take some money out of my IRA. Okay, well, let's buy a bond that matures on that exact date, pays you an exact amount of interest, doesn't have a sales charge in or out, and you're good. How's that? What do I get paid on that? Well, if it's only 1 year, probably 2%, better than a big zero and better than a negative. And it's your best option, and it's actually a pretty good option. My next seminar, which I'm going to make the reservations for this week, we're going to talk about that because there is a technique that helps with when you're doing fixed income. It's called bond laddering. Okay, and I'm going to show you how that works because this should be a big part of everybody's portfolios. And thank goodness for the programmers. I can't believe this hasn't been out a little earlier than this, but anyway, it's here now, and that's a really good thing. So we'll start to talk about it. Like I said, it is brand new. So if you're a client and I haven't reached out to you about it, it's because it's brand new. If you're not buying a fairly substantial amount of bonds, flip a quarter as to which way you'd be better off. But if you are buying a lot of bonds, then it's going to matter a lot. So this is kind of a big deal. I really like it. You're going to have to learn some of the language of bonds, like what's a premium, what's a discount. If you don't know what that is, I'm going to teach that. Okay, how often does it pay interest? Do I get interest like a treasury accrues interest every day that you hold it? So when you've owned it, you get the interest that bond would have been entitled to for that day the next time they pay out. That's pretty good. When you go to sell them, you're going to have to look at the current price that's being offered for it. They fluctuate, but if you get the right kind, like the shorter term, they don't fluctuate very much at all. That's a big deal. Why? Again, if you know you're going to need the money. If I had a daughter or a granddaughter who was going to be in college 5 years from now, and I knew I needed the money coming up in that's a no-brainer. You buy a treasury, a 5-year treasury, you're probably going to get about 2.6, 2.7 right now. It's not the greatest, but it will be there. If you put that in the stock market and the stock market decided to drop by 50%, are you going to tell your daughter or your granddaughter, oh, you're going to have to wait to go to college because I lost half your money in the stock market? Probably not a good conversation. Might be some people upset there, but so you just want to avoid that, and that's kind of what's kind of exciting. Whenever we get a new tool, this is the tone of voice I take because I like the new tools, especially when they're helping. And this is going to be a big deal, man. I mean, it's a huge deal, and I can't believe they've done it. I really can't believe it. You're getting access just like you were a major institution. You come through Bullington Capital because we are an institution. I'm not a major institution. These guys I'm small relative to the billion-dollar companies out there. Very small. But now they're letting me use the same kind of software that those guys have had for years. And I've been very jealous over that. Now it's available. So what do you know? And I think it's just gives another option. You want to try to get together an investment plan. A big portion of the plan is, hey, how much do you want to put in stocks? Stocks have the best long-term returns, but stocks always they also fluctuate a lot, not a little. They fluctuate a lot. So how do you reduce that fluctuation? Well, you put some of your money in bonds. And by the way, Treasury bonds, you don't have to pay Ohio state income tax on them. You pay federal tax on them, but not Ohio state tax, which increases their attractiveness towards CDs. You can buy CDs too. CDs are bought and sold between financial firms now, just like bonds are. And this is going to be it's always been a big part of the financial services industry. The bond market, the fixed income market, they like to refer to it as, is 4 times bigger than the stock market. Think about that for a second. It's 4 times bigger than the stock market. Why don't you hear about it? Well, first of all, it's kind of boring in most cases. Secondly, with interest rates being as low as they are, it's not it hasn't been as attractive. The rates have only recently started to climb. And instead of having to predict the market, by the way, if you look at the number of bond fund managers who have outperformed the bond fund index, kind of like if you're going to compare a stock fund to the S&P 500, that depends on what kind of funds these are. But the average bond fund has gotten beaten worse than the average stock fund has by the S&P 500. People they just can't resist trying to figure out the future ahead of time, and sooner or later, the vast majority of these guys, they guess and they guess wrong, or they estimate, and their estimate comes in inaccurate. And that's what they're supposed to try to do. It's just that it's an incredibly difficult thing to do, and it's really difficult to beat somebody who does a ladder. A ladder is a technique for buying the bonds. So you can buy a ladder. Here's an example. I would buy a ladder. The first bond's going to mature a year from now. The second one's going to mature 2 years from now. And the third one's going to mature 3 years from now. I'm going to go all the way out to 5 years. So what happens? Every year, one of those bonds is going to mature. The one that when I first started out was only 1 year away. A year from now, that one's going to mature. I'm going to replace that bond if I don't need it for income or something else. I'm going to replace that bond with a 5 year from that date. So it's going to go out past the first 5 year bond I bought, which has only got 4 years left on it now. And they just call that a bond ladder. That is one of the better approaches to managing fixed income that you will ever find. And it's also one of the simplest. But having said that, you can make this as complicated as you want to make it. Literally half of the Series 7, that's a very difficult securities licensing exam that you're going to take if you want to get into the business that I'm in with a retail brokerage firm. Literally half of that 7-hour exam is on bonds. So it's not that it can't be complicated. It can, but it can also be very simple. My example is the laddering approach. That laddering approach would have done way better than the BND, the Aggregate Bond Index, or the AGG. That's from BlackRock. It's another bond index. It would have beaten them all. Does it beat them every year? No. Nothing wins every year, by the way. That's another thing that I think an awful lot of people don't really realize. Nothing wins every year. But if you can finish in the top 20% each year, you're really going to accumulate a wonderful track record. So anyway, I just wanted to talk about that. That's a service that we're going to be offering. Again, the interest rates are somewhere between the 2 and 3%. 3% were the highest that I've seen in treasuries. Now you can find bonds out there that are paying 9 or 10%. So the problem is we don't know if the company is actually going to be able to pay them back, pay that interest, and then pay the bond back. Anything that's of investment grade, okay, is not going to be paying a lot more than 2.5 to 3% is a maximum. Okay, once you get interest rates that are past that, it's because there are problems within the organizations that are offering those bonds. And now that you hear the music, I can't believe that second segment's gone already. Well, you're listening to Bill Bullington right here on 1420. Stay tuned. I'll be right back.
The other day I was thinking to myself, made a list of all my mistakes. Oh, I wish I could have run to you and tell you all about my heartbreak. And I wondered to myself, wait a minute, am I even on the right path now? Had a couple wins, but I got knocked down. But I know that you are here right now, and you say, sometimes you
and I'm back. As I was just saying, my name is Bill Bullington. I'm here every Saturday morning. I've been doing this show for a long time now. I'm almost embarrassed to say, because then you get to figure out kind of how old I am. I'm just kidding. I really don't care. But, yeah, we were talking about bonds and bond ladders. That's a really good option to have now. And it used to be incredibly difficult because it was such a manual process. It took forever. And quite frankly, it just wasn't worthwhile. Now, outside of a super short-term bond fund, this is probably going to have a slightly higher yield than your super short-term bond funds are. The reason when you hold those is, for safety's sake, and they're basically just a holding place. I think this is an improvement over that. So if you want to learn more about it, just give us a call. The rates of return on these are not as high as the fixed indexed annuities are, by the way. They're a lot closer. They're probably half, maybe 3/4. Depends on how old you are. So the fixed index annuities actually have the highest incomes, guaranteed incomes for life, but they're different. They're not those other bonds are liquid. You can cash them in and just you don't have to pay a penalty or commission. If you want to get out of these others, because they're offering a much higher rate, they have to lock in much longer term investments to get out of that stuff. It would actually cost you money. So you have to decide, what's more important to you, higher income now or liquidity? If your ability to run in and grab the money for something that you might need is more important than getting more income, then you go with the shorter term ones. If you really just need the extra income, and I've had several people come in and say, I just want enough to be able to pay my Medicare supplement, which I think is genius. Set that up, and it's going to pay the Medicare supplement for you when you're retiring. And we can have them deposit the money into your checking account, and you can have it taken out. Same checking account. You don't have to do anything. And we help a lot of people do a lot of that stuff. In fact, it's mind-boggling. We do a ton of banking procedures. And, I never wanted to be a banker. There's a lot of paperwork, but that's one of the things that we do because we know, that's what our clients need. They need that kind of help. They need to be able to organize their stuff. They need somebody that's going to remember where their stuff is when they get really, really old. Anyway, so it's kind of a cool thing. And being able to bring these different options, see, there's no one right answer, one size fits all. That's just nonsense. But there is a method for you. And if you want to ask some questions, feel free. You can go to the website again. It's Bullington Capital. You can call us 330-664-0700. 330-664-0700. I will be more than glad to talk with you. If you hear something here that you'd like some more information on, feel free. This is it's actually my whole life, so it's pretty fun, especially when things are always changing. I thought they would slow down a little bit at some point in time, but instead, it's actually just gotten faster. Remember the snowball I was talking about, the technology that's coming out. There's a lot of the technology that's been out that people still don't know about. That's pretty interesting. And so I will get off of that stuff. Like I said, if you're the highest income, guaranteed incomes you can get are going to probably be from fixed indexed annuities. So if you're looking for a much higher rate of income that's guaranteed, you might want to look at that. If you're looking at stuff that you might need to cash in, you just want to keep it liquid, you might want to look at the treasuries or bonds in general. If you are looking for longer-term growth, well, ETFs, I think that's the best way to go. Individual stocks, I'll always have some individual stocks. And at some point in time, when we're able to get another seminar going, I'll be able to come in and show you what I've been doing with that stuff. I haven't been doing a lot. I have to be straight up with you because it's time consuming. It's really time consuming, especially when I'm looking at the scan from today, just this morning, and there are 93 companies on the list so far. And it's just the beginning of the day. So that's a lot to look through. It looked good, though. And by the way, that's a good sign. Normally, you don't see that many. Typically, you might get 30 or 40 on a normal day. On a slow day, you're probably only getting 10. And right now, they're at 93. So what that tells me is the market's kind of strong. I'm not sure why. You're never sure why until after the fact, by the way. Stock market predictors' number one job is to make a fortune teller look good. That's their number one job. Predicting what the market's going to do ahead of time, just good luck. And I know people say, well, you're predicting all the time. Yeah, 10 years from now. That's not the same as a year from now or what's going to happen over the next few months. Nobody really knows that. And if you could know that, it would, that really gets under my craw if you can't tell. It disturbs me because when you've done the show for this many years and people still ask that stuff. And I know everybody wants to know. Everybody wants to know. I would like to know. I just realized that there's only so much that you can know. There's a whole lot more that you can't possibly know. And the experts know the difference. They know the difference between what you can know and what you can't know. And when people get upset, it's because they're not expert yet. They don't know what you can't possibly know. They don't know what that is. They think it's completely reasonable to be able to predict where a stock is going to be a year from now. Because after all, it's Apple. You should be able to pick Apple, right, or Amazon or any one of the other large tech companies out there. Let's take Netflix. You should be able to predict that, right? And something happened in Netflix here lately. I saw the stock was down yesterday about 56%. If you look at where the stock was last December, it's down almost 70%. That's Netflix. What's going on at Netflix? I have no idea. All I can tell you is that the industry itself, a streaming business, okay, they were one of the first. That's why everybody liked them, because they were one of the first there. Now they've got competition coming out of everywhere. And, that's tough because you can't patent that type of a product. And it's just, it was overpriced, by the way, anyway. So when it was at $700, not really that interested in it. And that's the way that it goes. I mean, think about that. Trying to predict ahead of time can get you in trouble. You don't want to predict unless you're looking out more than 10 years. And if you're looking out more than 10 years, minimally 5. 5 is a minimum. If you're looking out that long, then the probabilities of stocks being higher 10 years from now are much, much, much higher than they are them being higher 12 months from now. The probabilities are significantly higher. It's actually about I think it's more than 70%, which is high. If you know much about statistics at all, if you don't, then you just have to take my word for it. Having a 70% correlation coefficient is incredibly high. But that's, the farther away you go, then the higher the opportunities are, or the likelihood is of stocks being higher. In the meantime, a lot of stocks are going to move. If you wanted to participate in that movement, it's not that easy to do. You can do it. We'll talk about that a little bit on the at the next seminar as well. You look at Twitter. Elon Musk has been talking about it, and the stock jumped way up on the news that he was going to try to take over the company. He's going to try and buy him out. Pretty interesting. The price to sales ratio on that is 6.79, and next seminar we do, I'm going to spend at least 15 minutes talking about price to sales ratio. It's a really good gauge of how undervalued or overvalued a company might be. It's not like a price to earnings ratio. It's a lot more accurate, and it's not the same price to earnings ratios that they say high is bad, low is good. Okay, well, this one doesn't work like that. Price to sales ratio, a high price to sales ratio could be good if the company deserves a high price to sales ratio. And how do you know that? It's based on profit margin. I don't want to give the whole thing away. Almost my whole workshop. Just kidding. But not almost. Anyway, Twitter was selling at a price. It was $72 last July. Let's see where the highest price on this was. So the fact that it's coming down now is not really that big a deal. That's the point I'm trying to get at. And if I go to, let's see, yeah, it peaked out around a little over $80, and that was in 2021. Wow. So it goes down during that year all the way down to $31. And people will go, well, why does it do that? And my answer is always the same, because it's a stock. That's what stocks do. They fluctuate a lot. Well, Procter & Gamble never did that way. Well, Procter & Gamble's then down 40, 50% multiple times in its career history. And by the way, Procter & Gamble is a great company. Procter & Gamble makes things that you're going to use. I don't care what's happening. You're probably going to take a bath. You know what I'm saying? You're probably going to wash your clothes. You're probably going to put diapers on your kids if you have them. Yeah, and if you don't, if you're old enough, you'll be wearing diapers. I'm just kidding. But the bottom line is, that reminds me of being in New York City on the day they were dropping the ball for Christmas. Oh my gosh! I mean, it was funny. They were sold out. People were buying the adult diapers so they wouldn't have to stop and go to the bathroom. I was like, you got to be kidding me. I will never go back to New York City on a holiday again. Anyway, but interesting. So Procter & Gamble it didn't come up on the screen, by the way. And these screens, when you're looking at these, the reason I even learned to do this was because there were some firms. Actually, the guy that owns the Boston Red Sox, what is his name? John Henry. The guy never went to college. He's a billionaire. And he used a technique that's almost identical to the one that I teach on stocks. Now, that guy had a lot of guts because he was doing the same technique, and he was doing it on commodities. He was doing it on gold and silver. And his annual fluctuation, the average fluctuation, was about 70% a year. So the reason that he's so rich is he's one of the few people that would stand in there and take it. He would just take it. He'd be down 70%, and then he'd come ripping back 350 or 400%, and he was fine with that. that was great for him. And by the way, you're not up that much when you're down 70% and you're only down up 300 to 400%. Actually, that 300%, you wouldn't even get back to break even. So you have a few really good years, and you don't mind a lot of volatility. And he knew what he was doing. They're slightly more sophisticated now. Actually, they're probably a lot more sophisticated now. But the basics of what he did to get to where he's gotten to were not that hard. And they're very well known by a lot of people that are in the industries. It's just very difficult to stay with it. There was another fund that somebody sent me the performance of. It was up 250% in 5 years. So I looked up the fund. Yeah, it was actually up 4,000% in the last year, which means it was down 90 before putting in that huge big run. And that's my point. When you want to make, if you're trying to make a lot of money, then you're going to take a lot of risk. And when you get older, you really don't want to do that. That's why we spent the 20 minutes talking about buying treasury bonds in ladders. Why? Because the risk-adjusted return on that is probably some of the highest that you're going to get. And you can say, well, yeah, but you said they're only going to pay 2.5% to 3%. Well, yeah, that's because they're the highest return with the lowest risk. See that phrase, lowest risk, that means something. Okay, and it means that you probably don't make as much money because it's low risk. Yeah. Same thing with a fixed indexed annuity. The risk is lower there than it is in a regular bond fund or a stock fund. The risk to your principal. The fact that they're willing to guarantee an interest rate that's really high is hard to match on your own. They can do it because they're a huge insurance company, or the insurance companies that are doing it, they're huge. They lend money to big organizations. They manage pensions. They've got sources of income coming in. People are paying their homeowners and life insurance to them. They have massive sources of income, and they're experts at numbers. Make the quants look kind of silly, actually. The actuaries do. If any of that means anything to you, then you know a whole lot about math. But the bottom line is these guys are experts at that, and you're better off letting experts handle a lot of that. And in fact, this new tool, I'm looking at the tool, and I'm looking at the suggestions that the tool is making. I'm going, yeah, oh man, somebody really did a good job with this, because this is what I would have done had I been picking these by hand, which is what we used to have to do myself. Horribly time consuming. That computer, the computer system, can go through the entire bond market and pull out exactly what I'm looking for in about 3 seconds. If I have to go through and look for it manually, it's going to take me about 3 hours. Now that's an improvement. So I'm so glad to see that these tools are finally making it to the general public. Actually, this is not available to the general public. It's for smaller firms like mine. We're under 100 million in assets. That makes me very small by the other institutions that are out there. Kind of large for the individual offices, but not that large. And we try to give a super high level of support and service, and that's what we kind of try to pride ourselves on. And if you are a client of mine, you're going to be hearing from me in the next few months as I go through the lists and try to get everybody up to speed on this, because it's a big deal. It's a big deal. When you're able to increase the return a little bit and reduce the risk at the same time, that's not that easy to do. In fact, it's very difficult. And we've got a new tool out here. I'm just really excited about it, if you can't tell, because I just keep talking about it. Stocks, by the way, great. We've got models out there that have done very well. Stock portion of the portfolios have done very well. We're offering now a slightly more simplified version of our main portfolio. And by the way, I own a little bit of both. And everything I talk about, I have money in. So I want to be right there with my clients, right on the front line, and experiencing everything that they're experiencing. So having said all that stuff, if you'd like to reach out, set up an informal phone call, or if you'd like to stop by the office, that's fine too. My website is bullingtoncapital.com, and my phone number is 330-664-0700. And most of the time I try not to have as elevated as a voice as I do when I'm on the radio, but because when I'm on the radio, I'm trying to capture your attention, and you're in your car most likely. You might be at home. A lot of my clients listen to radio at home. It's pretty interesting. The young kids don't do a whole lot of that. But anyway, I hear the music. That means my show is definitely over. Thanks for listening, everybody. Again, this is Bill Bullington right here on 1420 every Saturday morning from 11 to noon. Have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.